And we are live. Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you back here for another Wednesday with the macro maven herself, Stephanie Pomboy. Hi, Steph. How are you?
I'm good. How are you doing?
Good. Thanks for joining us. Nice to see you in your semi-permanent place now.
Permanent for the time being.
Yeah. Yes. So, we've had a little irregular schedule over the past 2 months, and part of that stuff is you have had a lot of curveballs thrown your way over the past couple of months, and I know we've kept a lot of that on the down low. But one of the offshoots of that, folks, just to be fully transparent here, is we are going to shift the cadence of Stephanie's appearances here. She's got a lot going on, and so we're going to shift from bi-weekly to monthly. I'm sure that's going to heartbreak a number of folks here, but don't worry, you're still going to get your monthly dose of Pomboy. And we have some other folks that are going to be appearing regularly too. So, we'll make sure there's content here every week. But anyway, Steph, look, we'll take whatever Pomboy we can get. So thank you for still doing the monthly cadence with us here.
I think you can just hear the audible sighs of relief that there will be some respite from me. But no, I mean, my only concern, of course, is that if we convene monthly, that we may be scrambling to cover as much terrain as possible, especially given, how quickly things are moving right now. So, but
well, exactly.
We'll make it work. So I appreciate everyone's flexibility with that.
All right. Well, look, yeah, I'm sure the universe is going to take this as a hold my beer moment and just say, okay, all that change you guys have been predicting, we're going to make it happen in between your appearances.
Right.
But hey, folks, we'll do the best we can here. All right. So lots to talk about here. I do have a bunch of visuals to pull up this time that I prepared. So Steph, I titled this session, because I have to title them in advance, is this the breaking point? And it's probably a little bit of a premature headline here, but we are, seeing a lot of,
cracks,
concern and angst that the market hasn't really shown, since probably back in April, right? We're seeing certainly the AI complex start to get a lot of questions. There's some interesting things going on in Japan, credit markets, private credit, people are getting more concerned about. So these little micro fractures that we've been talking about for the past couple of months don't seem to be so micro anymore. I don't know if we can call them macro fractures yet, but I think we can call them fractures. So why don't we start with this one? And forgive me for not preparing you for what I was going to touch here. But let's see here. Let's talk about Japan for a moment. So Japanese government bond yields have just soared. And you can see here, from 2021, they've kind of been up and to the right here, but they've been picking up momentum, and they are now at levels that we haven't seen in this data series, and I don't think we've seen for a long, long time. I don't even know if these are record levels or not, but would love to get a sense from you, Steph, as to the implications for this. And one question I have for you too, I don't know if you can answer, but I'll toss it out there anyways, which is, I have heard folks say that, if Japan, it's so over indebted that if its debt goes over 2%, just 2%, if bond yields go to 2%, it's going to bankrupt the country because of all the debt that they hold. They've got the highest debt to GDP ratio of any country, I think, out there. Is that true? Is Japan basically on a death watch now?
Well, they're in that doom loop, obviously, where, the higher debt service, the debt service is such a huge part of the deficit that it just is now in this sort of parabolic move upwards. So, yeah, I mean, I think there are a couple of interesting points. First off, it's the highest in 17 years on
17, okay,
long-dated bonds. And I'm just looking at like a benchmark composite of long-dated JGB yields, highest since, basically 2008. But what I think is really interesting, there are two things about this that are interesting. Number one, the implications for the yen carry trade. And, when the Bank of Japan sort of tilted away from its stimulative policy, people started to talk about the prospect of higher rates in Japan. and unthinkable, and that began to sort of shake the foundation of the yen carry trade. And of course, it has just kind of been compounding over that last year. But now we're at the point where it's really, clearly that trade is under significant threat. And I saw someone quantify the size of the yen carry trade at $20 trillion. I mean, just to give some context, I'm not really sure exactly how they came up with that number, but we know that borrowing in, basically cheap and certain to be cheaper yen at 0% has been a source of funding for global levered positions for well over a decade. So it stands to reason that it just keeps building and building and building. Right. So it's certainly in the multi-trillions. I don't know if it's 20 trillion. That seems like a very large number, but it's a multi-trillion-dollar bet, and it's a levered position, obviously. So
right. It was a sure bet. People levered up on it. It worked forever.
Yeah. And so everyone did it. It was just, the no-brainer. You just borrow in cheap yen and you use the money to buy whatever you want all over the globe. So we're seeing that start to unwind, and that may be a contributing factor to what you described as all these little cracks coming in random spots. The other thing that I think is interesting about it is what it portends for the U.S., because obviously what we're seeing here, and one of the catalysts for the recent acceleration higher in yield. I mean, obviously that chart shows yields have been moving higher for a while, but they really sort of popped in the last little bit, was that Japan unveiled this fiscal stimulus program. So essentially what I think is important about what's happening in Japan isn't just the unwind of the carry trade, which obviously is very important, but also what it implies for the US in terms of our move into what I would describe, and some people have described as the era of fiscal dominance, where we're going to end up having a similar situation, and already are, to what Japan is, which is we borrowed so much, our budget deficit, our federal debt, public sector debt is so big that the interest costs are really what's driving the annual deficit. And unless or until long rates come down, that's going to continue to be a massive headwind for the economy, but also it limits the capacity for monetary authorities to get long rates lower. And we've seen this borne out here, where the Fed started cutting rates in September, and the 10-year yield is exactly where it was on September 17th, the first time they cut. So they've accomplished zero in terms of their goal of easing credit conditions by bringing long rates down and everything that's tied to that 10-year, like mortgages, corporate credit, et cetera. So essentially, they're pissing in the wind, and so we're all in this same soup that Japan is in, albeit to varying degrees. And Europe's budget situation is very similar, the UK especially. So we're all the developed world economies are kind of in this predicament where they need, more than anything, because they're so levered, to get relief in the form of lower interest rates. But the conventional tools that they use to get there aren't working anymore, because everyone sees, basically everyone now sees the emperor has no clothes. They see the budget situation as untenable, and we're sort of exacting a risk premium for what were risk, no risk, safe borrowers. So if you're applying a risk premium to the Treasury, presumably you're not going to have lower rates across the private credit sphere either.
Okay, get a number of questions coming out of that. First, I just want to say that there's a periodic kind of bass rumbling, folks, you guys might be hearing on Stephanie's audio.
You can hear that.
That's not interference. That's her co-pilot snoring beneath her, correct?
Yes, that's her. I'm sorry. The soothing sounds of Bulldog are part of my regular backdrop here. So.
Well, I think more than probably the majority, I think the majority of viewers here watch more for Wilhelmina than anything else. Steph. All right, so your point about fiscal dominance, kind of a succinct way that I've heard fiscal dominance described is it's when the debt service cost gets so dire that the central planners have to prioritize lowering the debt burden or the cost of debt service versus inflation. They basically say, you know what, we've got this inflation control mandate, but you know what, we got to just toss that out of the balloon because the key thing is we just can't die by interest rate service costs.
Yeah, well, they have basically two options. They can either control the level of interest rates or they can control the dollar. You know, one of those is going to be the valve. And they're obviously, with a levered economy, you're going to choose letting the dollar be the valve all day, every day. And we've seen that basically since the Federal Reserve was instituted.
Was created, yeah.
You know, but it's just obviously now become very evident, and the purchasing power, the loss in purchasing power has really accelerated dramatically. And I would say if we are in fact at that point where we're starting to see the risk appetite unwind, hey, give it a minute, because we're going to see a massive destruction in dollar purchasing power as they take measures to try to mitigate that.
Okay, so a couple of things here, and I guess I got to start from what you just said. While I understand why you said it, and while I largely agree with you, I just want to make sure you're not giving the impression, folks, that, hey, this massive decrease in dollar purchasing power is going to happen over the next couple months or quarters, and the great end of the dollar experiment, is not necessary. You're not calling for it to end like within the next year. And correct me if I'm wrong, but there's a lot of people here who watch who are that's the thing that they're chained to the mast on. Yeah. And I don't necessarily want someone to take the wrong assumption from that comment you just made.
Yeah, no, I mean, I definitely think that we are at the end of the era of fiat money. As to when we officially get there, never forecast direction and time is rule number one. So I will forecast direction and withhold the judgment on time. But I would say it's not outside of my lifetime. This is, and I'm a pretty old lady, so.
Hey, wait a minute, you got a long time left, Steph.
I don't think we have. I don't think we have a decade left on this experiment, and frankly, I don't think we have 5 years left on it. But we'll see. I think it's coming probably sooner than most people don't think it's ever going to happen. But I think the speed with which this can all devolve will be rapid, and we're seeing it start to unfold already. And I think one example, and I hate to use this because it might seem hyperbolic, but when you take a situation like Renovo, which was this investment that I always get it wrong. BlackRock. I always call it Blackstone, and I need to make sure I don't slam Blackstone. So BlackRock had, and they were marking it, I guess, at 100 cents on the dollar at the end of September, and it went to zero. So that's how quickly these things can change, because a lot of this, the valuations are so extreme, both in equities and in a lot of these sort of opaque private credit and other illiquid credit instruments. So you could flip that light switch, and we might see the Fed instituting QE come May of next year when they install the new Fed chairman. So that doesn't seem to me at all outside the realm of possibility. And if we do start another round of QE, you're going to see the dollar go down very rapidly. Now, I'm not saying it's going to be the end of the dollar, but that will be the first step, and of course, we will have plenty of company with the Bank of England and the ECB and the Bank of Japan. Yes, exactly.
Yeah. Okay, so I think you've answered my next question already, but I'm going to ask it anyways. So Lynn Alden, who I've talked with a lot about fiscal dominance, she's known for this saying that she repeats a lot, which is nothing stops this train, right? And the question I was going to ask you is do you see anything that may stop this train or slow it down materially? But if you think potentially the fiat regime doesn't have a decade left, and maybe not even half a decade left, I'm guessing you're thinking, no, nothing stops this train. It's going to ride till it goes off the tracks.
Yeah, I just don't know how at these numbers, how do you stop the train? We're tinkering around the edges here. We're trying to get tariff revenue to kind of bring down the deficit, and we're trying to grow our way out of the deficit, which is certainly the preferred and noble way to do it. But again, we've now got ourselves in a situation where the debt level is so oppressively large that I agree. I mean, I just don't think there's a way to stop this train at this point.
Okay, just to connect another dot here too, Darius Dale, who I interview periodically, he has these I forget what he calls them, but they're basically these different regimes or different strategies, right? And he's got names for them, A, B, C, D, and I can't remember which is exactly which. But he's basically said, yeah, the current administration is they've grabbed the grow out of this problem playbook, and he says, but it's not going to work. And so, they're going to revert to the print out of this playbook. And honestly, he's like, they need to get there faster than they're doing it right now, to try to prevent the economy from falling into potential recession here. So anyways, all I want to say is there's a lot of other people out there who use their own methodologies who come to similar conclusions as you, Steph. So you've got good company.
Well, I think we're also in kind of it's interesting because it's really a race. A lot of the one big, beautiful bill stimulus is going to impact in the early part of next year, as you have, it's all related to this year's tax filing. So you'll get a huge increase in tax refunds, and the withholdings will change. And so all of a sudden, some of the distress that we're seeing at the low end of the consumer chain will start to alleviate. Hopefully that's the goal, with this, the stimulus coming from higher income, after tax income. The problem is that if what we're seeing now in the markets snowballs and we enter a risk off sort of mode, all of that is going to be completely wiped out by a reverse wealth effect. And Peter Atwater sent out a little missive the other day where he observed that of all the things that are going on in the market, one of the most interesting things that no one's looking at is the performance of American Express, which caters obviously to the high-end consumer.
Mm-hmm.
They had some kind of a larger charge-off than people had expected. So there's obviously something going on there, and the stock is down substantially. So if you view that as kind of a window into what's happening in the high end of the consumer sphere, and you start to get that kind of thing, people concerned about the outlook there, Katie bar the door. So this is kind of a nail-biting period here between now and year end, because if we can make it through the end of the year and have the Santa Claus rally that everyone anticipates we're going to have, and then get into 2026, that stimulus could really help support the consumers and kind of maybe help us at least churn sideways for a little bit and try to muddle, maybe we get another year of this kind of muddle through phenomenon before, what hits the fan. But it's going to be a close call.
Okay, so like any great interviewee, you keep anticipating where I want to go, Stephanie. So I was going to ask you about exactly this, and I was hesitating to include this just because anything that is related to the president is partisan, and I've definitely seen a rash of it quite recently on this channel, when even a guest kind of passively mentions President Trump. But I'm going to bring it up anyways at the risk of this. And folks, not making a partisan comment here, and I'm sure a lot of people here, they're going to totally disagree with this truth from Donald Trump's Truth Social. And he's basically saying, he's talking about the Epstein bill, and he's like, I don't care if it passes or not at this point in time, or when it passes. He's like, I just don't want us to take our eyes off all the victories we've had. And this is what Trump's really trying to do in a lot of his public comments recently. He's saying, hey, look, don't forget, we've got a lot of wins. Great, beautiful bill, closed borders, no men and women's sports or transgender for everybody, ending DEI, stopping Biden's record-setting inflation, biggest tax and regulation cuts in history, stopping 8 wars, rebuilding our military, being respected by every country in the world, having trillions of dollars invested in the USA. He talks about some other stuff. And so where I'm going with this is, yeah, there's a lot of bombast in there, if you will. And I'm sure a lot of viewers will take issue with whether those are true victories or not, right? But there's a lot of stuff in there that isn't refutable stuff that's related to the economic policies you were mentioning, the tariff revenue, the new trade deals, the trillions of investment that are coming into the country. We have the premier of Saudi Arabia in the country right now, upping his commitments, which I think are at $1 trillion or more, right? And so there was all the provisions of the big, beautiful bill. There's the tax relief. There's the deregulation. So the question I was going to ask you, because I know you have recessionary concerns, was, hey, is that a cavalry that is riding to the rescue potentially in 2026 that might actually stave off recession? And what I just heard you say is we can't discount it, and it will be additive in terms of tailwinds to the economy, but TBD what the headwinds of the economy are going to be. But if we go into a material enough market correction that then generates a negative wealth effect from the affluent consumer base that's been keeping up retail spending, I think the term you used was Katie bar the door. Yeah. So a lot does hinge on what's going to happen in the markets over the next couple of quarters, correct?
Yeah, I mean, I think the market is the tail wagging the economic dog. And as relates to, what you just put up there and everything, the accomplishments in the administration, I mean, I think that, my view is this was an insurmountable challenge, basically to come in and to take the reins. I mean, think specifically of Treasury Secretary Bessent and what he faced. And, he's got to figure out a way to finance these deficits at a time when our foreign creditors are fleeing. And, we've entered this era of fiscal dominance, and he's been forced to continue Yellen's program of, issuing all the debt and then working in conjunction with the Fed, who's now going to be taking its MBF, its maturing MBS and recycling those dollars into the front end of the yield curve. So they're doing all these things to try to hold it together, but they were handed an impossible situation, in my view. That's just talking about the deficit. Then you're dealing, with what happened with the inflation. And then I think that's what prompted the president to rail against Republicans for not messaging well, because he's looking at the inflation rate going from 9% under his predecessor to whatever it is now. We don't know. We'll wait and get a number, but and he's saying, look, I've accomplished a tremendous, inflation's a lot lower. And that may be true, but the problem is that for the average consumer, the fact that prices are going up slower gives them no relief, because prices were already way too high. So unless prices actually decline, the actual price level, he's going to have a really hard time persuading people that he's accomplished much in the fight for inflation, because people don't, these CPI numbers are irrelevant to the average consumer. They don't give two what's about how quickly or slowly the rate of inflation is going. They care about what they spend every week at the grocery store, et cetera. So this is the struggle. And I'm not sure there's really any way to message that, just because the situation is what it is, unless we see outright price declines, people aren't going to feel better, and they're not getting declines in mortgage rates either. So you're in this environment where the price level kind of is moving sideways. Mortgage rates, credit card rates are all moving sideways, and they're doing so at levels that are so much higher than they were just 5 years ago. And so it's a tricky problem. And that's why I think you see consumer sentiment and consumer confidence numbers that are worse than they were during COVID. Right. And in some cases, worse than they were at the depths of the Great Recession. And people on Wall Street are like, oh, they just don't know what they're just mimicking what they're reading in the headlines. No, I mean, this is where they are. So anyway, that was a ramble about, I don't know if that even answered any question, but
no, it does. It's very germane. By the way, just to connect one more dot, it all ties into the interview that I just did yesterday with Craig Fuller, CEO of FreightWaves, who he tracks supply chain data. So he basically tracks the economy of real things, right? Things that need to get shipped from point A to point B, right? All the parts of the economy that aren't, in the AI digital sphere, right? And one of the things you mentioned is that,
transcontinental. That should have been your
yeah.
tagline for that one.
But he talks about how if you add up all the employees and kind of the Mag 7 digital economy, it's like 2 million people, 2 million workers. With the part of the economy that he tracks, it's like 35 million workers, right? And so, it really shows a tale of two cities. The 2 million in the AI space are making money hand over fist with their stock options. The real economy, he said, is the exact words were very, very, very weak. But I think he would also agree with me describing it as recessionary. So just like you were saying, like that's where the majority of America is right now, right? Yeah. So obviously what becomes really important in this space is what happens with the jobs market, right? Because no matter what's happening with prices, if you've just lost your job, you're in a much worse place. And we haven't had a lot of data from the BLS of late because of the government shutdown. We did just get some September jobs data coming out, though, and it said that only 22,000 jobs were added. The unemployment rate has now ticked back up to 4.3%. We'll get more detail on that as time goes on. But the official numbers, which I think we all agree are generally too sanguine, are not looking that good right now as well. And we have seen near record corporate bankruptcies this year. We've definitely seen a steady drumbeat of companies announcing larger and larger layoffs. Again, we're not in the territory we were in the last big recession, but the trajectory isn't very good. So to your point, Steph, we've got people who are feeling like they're hanging on by their fingernails. They're debt financing out the wazoo just to stay alive. The jobs market is looking less good for them, and inflation isn't coming down much from where it's been stuck, and may not, to your point of fiscal dominance, where they're starting to take the eye off the inflation ball because they just got to figure out how to not let the debt service costs kill them.
Yeah, absolutely. I mean, that's the hard thing is it's not clear to me that you're going to get much relief, certainly not on the interest rate front. And the way you're going to get relief on the price front is to have an actual recession. So that will throw people out of work. And the one segment of those sentiment and confidence surveys that is worse than it was in the Great Recession are the real income responses. So whether it be a combination of expectations that prices will remain elevated or that employment prospects are going lower, consumers rate their prospects for positive real income the lowest in history. I mean, that's kind of breathtaking when you think about it. So anyway, I definitely think that is an issue to be concerned about. And again, I hate to be snide about it, but it makes what's happening at American Express also extremely important because the tail wagging the dog for the consumer sector has been the high end. The reason why every time you turn on CNBC or any of these financial media networks and you listen to somebody just throw out as if it's fact, the consumer is strong, is because they're looking at aggregate statistics that average the people who are just, minting millions with all their investments in the financial markets, with the low end that, is struggling just to stay afloat. So the averages really don't tell you anything meaningful. It's that high end that really is driving the bus.
Yeah, and I've probably mentioned enough on this channel. People are sick of me bringing it up, but you really have to appreciate the difference between mean and median, because the mean hides a lot, right? The averages hide a lot, as you're saying. you look at things on a median basis, they tell a very different story. What's sad about all this is, Steph, it reminds me a lot, and I think we've talked about this, when I used to live in Manhattan, and I just never really got the logic there of like, well, we have to take really good care of the bankers because they spend all the money that makes, the city work. And I was always kind of like, well, why have we anointed these guys princes, right? Why don't we just make it more equitable for everybody, and then everybody can spend the money, right?
Yeah.
There seems to be a real sense of, well, we got to keep those affluent people spending because, to your point, they're the ones that are keeping the averages up. It's like, well, wait a minute, like, why did we end up in this policy situation? Why don't we start developing policies that are, maybe a little bit fairer to all? And I know that was a big part of what Trump ran on. And to your point, I don't know. I still think that the administration probably, if it should have let the economy fall into recession, right?
Yeah.
I'm talking just as a political strategist. Early on in this year, you could have blamed it all on the previous administration, let things heal and be in a healing uptrend when the midterms arrive next year. I think it's anybody's guess right now whether or not we're going to avoid recession before the midterms. If we are, hard to believe that the Republicans would keep a hold of Congress. And to your point, I think even flat is a loss. I think if we just kind of hang out where we are, the majority is unhappy enough that they're going to look for somebody different. And the recent elections that we just saw, in the November elections, particularly in New York, but there have been some other progressive candidates like that have had notable wins. And it's because people are saying, look, I don't care if you tell me that their policies are dumb, they're different. And I just know what we have isn't working for me personally.
Yeah, I mean, I think that Mamdani win was a shot across the bow. It was an indictment of the K-shaped economy. It was people saying, we're not going to take it anymore. These policies that are skewed to favor the top end of the K and have been used for years and years and years to our detriment. We're going to do something to make sure those policies change. And so they elected this guy. I mean, it's amazing to me how sort of, I don't know if complacent the word is, or nonplussed the markets seem to be about the fact that the financial capital of the world just elected a socialist as mayor. This is like capitalism and socialism, in direct confrontation.
Right. It's like 2 years ago, if we were to bet what city was going to have a Democrat socialist mayor be elected to it, New York would probably have been the last city on the list, given that it's supposed to be the most capitalistic. Hey, Steph, sorry to interrupt. I just want to check one thing. I might have somewhat misspoke because this guy is going bananas in the chat here, saying Trump did not run on equity at all. And then he kept making some other comments. What I meant to say was, he ran on a message of the system's unfair and we're going to try to start prioritizing Main Street over Wall Street. That's what I was meaning. Equity, the wrong word. Maybe I should have said equitable or fair or whatever, but certainly not the DII kind of equity.
Well, and Secretary Bessent has repeated that at every turn, that this Main Street's time has been his phrase. Like Wall Street has had plenty of, time in the sun, and now it's Main Street's turn. And the components of the one big beautiful bill with the no tax on tips and the no tax on Social Security and all these things are obviously geared toward helping Main Street. But as you said, unless they can get relief in terms of lower interest rates and lower price level, they're probably not going to be particularly positive about what you're experiencing.
And after a certain amount of time, it begins to work against you if you keep saying, well, we're for Main Street, but everybody's like, yeah, but I see Wall Street continuing to get all the benefits. Stock market goes up, my job is getting cut, So at some point you really got to deliver. And that's probably, I think, a little bit behind the $2,000 checks to households, which, to me, that smells a lot like what the previous administration did. And a question I'm not hearing raised at all in the mainstream media is, well, we sent checks to households and we saw more inflation. So are we signing up for the same thing here? Or do we want to do that? Right. So anyways, I'm not a political analyst. I don't want to get too much in this territory. Let me, if I can, let me wrest it back to some other big questions, Steph, and let me put one more chart up here. Okay, so we talked about how a lot of the AI stocks are now starting to cool off. We've got some doubts creeping in about the level of capex and whether it can be afforded and whether we're going to get enough of a return off of it. Here was a notable chart I just saw, which I want to pull up here, which is that all of a sudden fund managers have flipped in their sentiment as to whether companies are over investing or under investing in capex for AI. And of late, it's been, oh my gosh, these guys have to go spend all this much because it's the biggest prize in the world, and we got to chase it. But all of a sudden, this month, they've now said, oh, you know what? I'm beginning to get more concerned that beginning to get more concerned that these guys are spending too much. And I'm now worried that they're not going to get a return on their investment. And anyways, I just thought that was a very notable sentiment shift. What are you picking up in the AI space right now?
Well, two things. Number one, Michael Burry, restructured, whether he actually closed or sort of restructured his fund. Basically, he endured as much pain as he could shorting the AI stocks. And so I think that's an important signal. But the other thing I wanted to say, I was going to ask you with that B of A fund manager survey, the one chart that I thought was interesting was the cash levels. So while they're saying they're concerned about these AI companies over-investing or companies over-investing in AI, they have their lowest cash position, I think it was, for decades. I mean, it's one of the lowest cash positions in multi-decade.
When you say that cash position, this is of fund managers?
Yes. Yeah.
Okay. So as concerned as they are, they're still all in.
Yeah, exactly. So they may say that they're starting to get a little concerned about overinvestment in AI, but they're still max long, So, but that's another reason to fear what we're seeing in terms of the cockroaches and how many seem to be appearing, is that there's a lot of room for these fund managers to raise cash without bringing it to a level that was in any way exorbitant.
Right.
If they raised their cash positions by 1 percentage point, it would probably still be low in the context of history. Mm-hmm. So yeah,
that would be a sponge sucking liquidity out of the market, right?
I'm sorry?
I mean, that would sort of act as a sponge sucking liquidity out of the market, right?
Yeah, absolutely.
Just to get back to traditional cash balances.
Yes. And I mean, I think this is another sort of thing that I've always found fascinating. From the day that I started my career on Wall Street, which is over 30 years ago, this notion of the money mountain has been out there, the cash on the sidelines. Look at all the cash on the sidelines. And admittedly, they weren't talking about the fund managers per se, but they were looking at money market funds and the teeming amount of money that was sitting in money market funds that was ready to roll into the stock market at any moment. That story has been around my entire investment career.
Right.
And what people fail to look, you have to have context. So they look at the absolute dollar level. It would be like saying, look at GDP, it's hitting record highs. Well, it goes like this, that's what it does. An object in motion tends to stay in motion. So it's the same with money market funds. They're just tracking growth in the economy and inflation and assets, et cetera. But relative to total financial assets, cash positions, be it in institutional managers or in retail accounts, are very, very low. So this notion, if you hear people, this is just me ranting to anyone on the sidelines, that if you hear someone tell you, hey, we haven't seen anything yet, all this money's coming in from the sidelines, look at all the money market funds, you just send them to me and I'll set them straight.
Absolutely will do. And I know that John Hussman rants a lot on just the math of this as well, but I don't want to get I don't want to get stuck in that with the limited amount of time we have left. So Burry has raised some interesting questions of late about it's sort of piggybacking on top of all the circular financing that's been going on, but questions of, if not outright fraud, just suspicious, potentially deceptive behavior going on here. Burry was specifically talking about the amortization schedules, the depreciation schedules for the chips. But it seems that there is more and more concern getting voiced on a daily basis about the sustainability of the financing in this space. And curious to hear what you think about that. And just to throw a little bit of levity in there, I did put a post out on X yesterday because there was yet another big deal with a bunch of these companies packaged together. I think investing in Anthropic, and then Anthropic was going to then invest in some Microsoft cloud compute, and then it was going to buy some chips from Nvidia, and of course it was getting money from all these companies, right? So I said I'm really awaiting the headline which says OpenAI private valuation surges upon news that the company has decided to take a 20% stake in itself.
Right. It would be like a page out of Michael Saylor's book, basically,
Well, I mean, yeah, it seems to be, and I'm going to get to Bitcoin in just a second here, but what are your spidey senses telling you about the likelihood that we're going to enter an era, maybe in the not too distant future, where it is not, hey, those are the haters just tossing out unfounded accusations, to, hey, just like the dot-com era with all of its crazy vendor financing, there was just a lot of hanky-panky going on here, and we get a discount for that now.
I keep coming back to Jim Grant, and he is such a brilliant wordsmith, and his description of the environment today was, we're going to find out all the mischief that takes place at 0%. Mm-hmm. And it's such a beautiful way to articulate where we're going, because we spent basically a decade with this repressive interest rate regime where people could borrow at zero and fund whatever high-flying nonsense operations they wanted. I liken it, he's sophisticated. I bring everything back to Seinfeld, and I think about George Costanza trying to go up to a girl, and he says, hi, my name's George. I'm broke. I live in my parents' basement, and I'm unemployed. And that's basically, it was like companies with no prospects and no business plan whatsoever were able to get money, thrown at them in this environment of 0%. And now we're seeing all of that come home to roost. The zombie companies, now 1 in every 5 companies can't service their debts out of their income. Obviously, as you referenced, all of the bankruptcies that are going on. And then you've got what's going on in the private credit space, which has been delightfully obscured behind the curtain, but now is coming to light as we discover that a lot of these companies were complete frauds. We had the shot across the bow with First Brands and Tricolor, and then you get this Renovo thing. And it turns out, fraud is what happens at 0%. It's part of the mischief at 0%. Right. But I think,
and sorry, but just in the private credit, it's 0% plus no oversight.
Absolutely.
No regulation. Yeah.
Like covenants, no nothing. And then you have things like, and this is why I think we're really starting to get into a risk-off mode. You get Blue Owl, for example, where people were like, okay, we want our money back. And enough people came and wanted their money back because they saw what was going on, probably with the First Brands and Tricolor, and said, hey, these guys are invested in all the same kind of toxic stuff. We're going to get out before it's too late. And of course, they said, no one's getting out. You're all stuck. We're lowering the gates. And in that environment where funds are doing that, okay, fine. So they prevented the outflow for a minute, but ultimately it just feeds the rush to exit.
Right.
And so I think that we're really at a tipping point. I do feel like we're at an inflection point now in terms of the outlook for risk appetite. And one thing I've been looking at the league tables to look at credit issuance, because, we've been seeing massive corporate debt issuance, a lot of it to fund investments in AI. But when you look at levered loan issuance, which is, sort of the more lower credit quality type of stuff, it has completely dried up in the last couple of weeks. So, you went from having decent loan issuance to now, I think the number of deals thus far in November are the lowest going back at least to 2014. So,
wow.
Yeah. So
And this is starting to be kind of counterparty risk issue, meaning where just like lenders just don't want to lend to people because they're just not certain they're going to get it paid back. And then if that then, spreads into lenders not wanting to lend to other lenders, that's when we get into real trouble in the credit markets. Hey, real quick, I just want to put this chart up because it's, again, you anticipated where I was going to go. This is the S&P, which is the green line, versus a lot of the major funds that are in the private credit space. And you can see here, starting from sort of the end of the summer, the past 2 months, the bloom has really come off the rose, where people are to your point, they're starting to get increasingly concerned about what's happening in private credit. And you mentioned Blue Owl. I think it was the interview I was doing with you, Stephanie, where I mentioned that I had seen, we were talking about buy now, pay later, and what an obvious future grenade that's going to be. Yeah. And I had seen an article probably like a month ago where PayPal, they have created their own buy now, pay later service for people paying through PayPal. And they sold their book of those loans. And it just seemed like PayPal just sort of knew, hey, we're originating these buy now, pay later. We think this is junk. Who can we sell it to? Well, who'd they sell it to? Blue Owl, right?
Oh, gosh. Wow.
Yeah.
Amazing. And, who's invested with Blue Owl? Probably pension funds, insurers, a lot of that. So, yeah, it's, but here's another one I want to flag for you, since you're looking at buy now, pay later as a possible, debacle to come. I have a really smart hedge fund guy that's a client, and his hedge fund does nothing but U.S. financials. And we had a call the other day, and he said, Stephanie, I want to make you aware of something that you might not have heard of that I think is going to be a debacle. And it's BPL, not BNPL, but BPL. So stop me if you've heard of this before. It's called business purpose lending.
Okay.
It is basically business lending, but essentially these are also called like fix and flip loans. So people who are home flippers who go in and, buy up properties and flip them, it's financing. So it's essentially collateralized by residential mortgage, residential real estate, but it's to these sort of small business entrepreneurs. So
entrepreneurs/speculators, but yes.
Right. So in an environment where you have money going to people who may not be, the savviest business people, and you're at the nexus of a deflation of the real estate bubble, and you've got this thing, it seemed to me like this is probably the worst intersection. You've got the potential for residential home prices to go down, and this tremendous leverage built up by these flippers that could go bad. So that's just another thing to put on your radar. And I'm sure, when you look at some of the big investors in that, you come back to all the same people that you just had the chart of. So it's like Renovo. Renovo was doing exactly that, although apparently, just like Tricolor, that was supposed to be a fraud, and these other things aren't frauds. So, it's all endemic of the mischief at 0%.
Yeah. So let's get to the rubber meets the road in the last 10, 15 minutes we have here, Steph. So we talked earlier about, all right, if we can get a Santa Claus rally, and then we can get tailwinds from the administration's economic policies, maybe that wins out and keeps us, in the positive territory through the end of, through 2026. But of course, the big risk there is a market correction that then creates the negative wealth effect. From the stuff we're talking about, it's you got to have a really compelling argument to say, hey, these things aren't going to matter in 2026. I'm going to guess you think they are. So in your sort of default outlook, are you expecting a market correction that then creates a negative wealth effect that causes some economic cascades?
Yeah, I think so. And I'm mindful that I've had this sensation before, but things really, and I hate to say, they feel more real this time. I'm looking at things like the outperformance of investment grade paper versus junk. And even when you had periods where spreads were increasing, in the corporate space. Normally what you had was that spreads were increasing faster for investment grade and less for junk, because people still were preferring to get the higher yield, and we're still, even though things were broadly selling off, they weren't selling the high yield stuff as quickly as they were the more quality paper. That's different now. That has changed, and investors are getting much more discerning about risk. And you're seeing that also in the equity market, as you mentioned, with the Mag 7 and the scrutiny about, hey, what really are the returns on AI? And might we be overestimating what those returns are going to be? And maybe there is some element of, circular investing, et cetera. So there's a little bit more scrutiny, which was not something that was taking place for the last several years. And again, I come back to that levered loan thing, because if the supply of credit starts to shrink as people become less inclined to lend, then it's game over, because this economy requires not just credit to go, but an ever increasing amount of credit. So it's not enough for us to borrow the same amount we borrowed last year. We have to borrow more if the economy is going to grow. So this is really, it could be a major inflection point if these things don't just turn on a dime, and we'll see. But, you're looking at the Fed meeting coming up in December. We're waiting more immediately on Nvidia's earnings tomorrow. And so there are a couple things that will give us some insight as to whether this is going to continue to devolve or not just in the next couple of weeks. But it really feels different this time, at the risk of uttering that dread phrase.
Yeah, what I hear you saying is for the first time in perhaps a long while, risk is starting to matter. And that could be what changes things here. So you mentioned two things real quick. The markets have been playing an interesting yes they will, no they won't game in recent weeks about the Fed, whether the Fed's going to cut in December. And I think based on the past couple of days, both with some of the economic data and with some of the proclamations by a few of the folks on the Fed, the market's now beginning to think, hey, they're going to actually cut again, right? So back and forth. Curious, do you have a inclination, predilection one way or the other?
I'd be surprised if they didn't cut. I just feel like, we'll probably get tomorrow. We get the payroll report, probably be pretty weak. And maybe that will give them some fodder to cut. I think they will cut, but I'm not going to make a bet on it. I still don't think it'll matter. It won't mean a thing. But I also think more broadly, the fact that the market is gyrating from day to day. First we had Bostic announce his retirement, the stock market flew. And then the next day you got some hawkish comments from some of the Fed governors and the market tanked. And the fact that the market is this vulnerable to, what's going on at the Fed, never mind that their rate cuts have had zero impact whatsoever, just bespeaks to me how massively overvalued the stock market is. The only thing that can keep it at these levels is continued monetary stimulus. And absent that, you have to do a lot of sort of self-reflection and look at, hey, is AI overvalued? Hey, might we be overinvesting in this? Hey, maybe consumers are stretched. Hey, maybe private credit is bursting. All those things become important in the absence of continued monetary stimulus.
So you need to have the stimulus, and you need to have the narrative, right? You need to have the story that everybody buys into. And right now that story is AI. And you mentioned, right now the world is basically waiting on Nvidia, and there has been a lot of negative news start to creep in, as we've been talking about. So Nvidia better have really encouraging forecasts, because if it doesn't, we've seen weakness in a lot of the other AI players. If Nvidia disappoints, that could be the domino that then really starts everything.
Doesn't it seem like even if they deliver on expectations, the market's going to absolutely tank, right? They have to blow the doors.
Exactly. They have to really surprise to the upside. I think to your point, a meat is a loss here.
Yeah. Yeah.
Yeah. And it's interesting. I mean, I'm trying to think, has there ever been a time that I can remember where so much rode on the results of a single company? I don't know.
I would guess probably in the .com sometime back then, there was probably,
but we didn't have a single tractor that was pulling everything back then. Now, Enron was the thing that caught everybody by surprise, but it wasn't like there was one .com company that was like driving the entire ecosystem.
Yeah, maybe not. Yeah, I can't remember.
Yeah. So, okay. So, you mentioned, risk. We're starting to see more risk-off sentiment now. Again, folks, I'm going to say it wouldn't shock me to see a Santa Claus rally, because these things, take a while to break. And to the topic of or the title of today's video, is this the breaking point? Steph, I'm kind of hearing from you, maybe, don't know yet, but certainly has some of the hallmarks that we would expect. We need more data and more, we'll see what happens, but it's certainly not a no. So what's interesting is we have seen risk-off assets like gold and silver, kind of hang in there, right? They've been bouncing back and forth, both flirting with, gold support at 44,000, silver support at $50 an ounce. When we started this, they were up quite nicely today. They're not up quite as nicely, but they're still above those thresholds that I mentioned. I want to contrast that with Bitcoin, and this is a screenshot I took right as we hopped on, Steph. I just checked on my phone. Bitcoin's now below 90, so 89. So it's really interesting because both of these are assets that I think pundits expect to do well, at least on a nominal basis, for the currency devaluation, outlook that you were talking about earlier. But I think very clearly one has been trading like a risk-off asset and one's been trading like a risk-on asset. And Bitcoin's decline here, I think, is showing people's increasing jitters on the risk-on trade. So I want to give you a chance to opine on either of those things: gold, silver, Bitcoin, whatever.
Well, I've long viewed Bitcoin as a risk asset rather than a safe haven. So I totally agree with your analysis of that. As relates to gold, when you think about things, if we go back to the conversation at the very beginning about unwinding the yen carry trade, just broadly, if we're in an environment where there's a little bit less inclination toward risk and people are trying to reduce a little bit of their exposure to it, you're going to reduce exposures across the board. You're taking everything down. You're reducing your leverage. A lot of these speculative hedge funds, might have been 3 times levered or 5 times levered, and they're saying, hey, maybe we want to take that down. And what they do is just basically take down every position X% across the board. And so everything goes down. It's like, a rising tide lifts all boats and a receding tide takes them all lower. And so gold gets, hit in that process along with everything else. So I was not surprised to see that. I also felt like you had seen, and I think we talked about it in our last conversation, a lot of retail interest came right as we broke some key price levels. At 3,500, you had one wave of retail investment. And then at 4,000, you had a huge rush of retail investors into the gold ETFs. And in the round trip back to we went to 4,300 and came back down to 4,000. All of those people who entered at 4,000 exited. So you flushed out a lot of those Johnny-come-latelys. So the people who are inclined to just look at a chart and chase it, they're out. And that's why I think gold has since resumed its footing, because now it's back to the real money buyers who were always propelling it forward. And then you see larger stories, more on the central bank purchases, India, China, obviously, and now into silver as well. So that entire precious metal space is continuing to get support from the dollar diversification by global central banks. And then the last point I would make on that score is we got the Treasury capital flows report yesterday. which looks at monthly, capital flows into treasuries and corporates, et cetera. And it showed a huge increase in capital flows, which is probably where most people's analysis ended. But if you looked at central bank purchases of US treasuries, they actually declined again. And India was one of the most aggressive sellers of US treasuries. So again, that they're shifting into gold and silver and other precious metals, and they're doing so at the expense of the dollar, which brings us back to that whole question of, what is Scott Bessent going to do in terms of getting debt service down without the help of foreign financiers. So anyway, it all comes back to the same fiscal dominance question, and I think gold will continue to just move higher, albeit not in a straight line, because nothing ever does. And Bitcoin, I think, has demonstrated itself to be what it is, which is a speculative asset.
Yeah. This is a question that Andy Schechtman raises a lot, but I'm curious if you have any thoughts on it, Steph. So, people might look at the U.S. and start to get concerned by its debt to GDP ratio, its levels of indebtedness. But one of the things that Bessent has mentioned at times is, hey, we want to try to monetize our balance sheet. And, one thing that they could do is, I think gold is valued at what, like 42 or $3, right, on the U.S. balance sheet. I mean, they could just do a mark-to-market revaluation and say, hey, we all of a sudden look a lot better, right? Here's a question: why wouldn't they do that? What is the benefit of holding gold at $42 an ounce?
Yeah, I don't know the answer to that question. I don't know why they don't do that. So you would think they would. I guess the only possible wrinkle is, what if it turns out that China owns more gold than we do, and they do the same thing? We revalue gold, and all of a sudden, we find out that they win the gold contest. Then their currency becomes substantially stronger than ours. Is that necessarily a bad thing? I don't know. I mean, this administration, it's tricky because they purport to be interested in portraying the strength of the U.S., but they don't really want a strong dollar, So they're really kind of threading a very fine needle there. But yeah, I don't know why they don't do that. It's interesting because they're trying a lot of other things, like Fannie Freddie is a way of privatizing the balance sheet, essentially, by saying, we're going to sell that and take all the money from selling our stake in Fannie and Freddie. And that, who knows how many $100 billion they would get from that. So they're trying a lot of things that seem to me to be far less compelling than what you talked about. It's just revaluing the gold. But to me, that happens when we get to the point where the Fed has expanded its balance sheet so far that the dollar is absolutely imploding, and we're forced to go back onto some kind of direct or indirect link to gold, and that's when they would do that. But maybe that's what they're saving it for. I don't know.
All right. Well, I don't know. But whatever they do, I'm sure we will be reacting to it live here. So, Steph, last question before we wrap this up. Has any of what we've talked about here today, these issues, have they caused you to make any material changes in your investments or your investing outlook versus your last time here? Are you still pretty much going with the portfolio construction you've got?
Yeah, no, I'm boring. I am, set it and forget it. So I've got my gold, tiny bit of cash, and where I have, income that I want to deploy, I'm putting it into energy, because I feel like I've got plenty of gold exposure between the bullion and the miners. And I think energy is really going to be the next big story.
Okay. And we have talked about that. Folks, just to let you know, I am working with Rick Rule to have him come on the program at some point before the end of the year to do a deep dive in oil and gas and the opportunities that he sees there. I know people have been really interested in that. On a related topic, I am interviewing Rain. Rain is one of the top geopolitical think tanks in the world. One of their analysts you've seen on this program with me several times, Ryan Bull, he's been their Mideast analyst, and we've reacted in real time to, some of the developments that were going on in the Middle East between Israel and Iran and the U.S. bombing of the nuclear facility there in Iran. So I've asked Rain if I could talk to their South American specialist about the situation in Venezuela, what's going on there, really understanding kind of what's at the heart of it, and trying to get a sense of what would be the implications if there was a replacement of Maduro there, and potentially if in a good way or in a bad way, but also, if the country did open up more towards the U.S., what would that mean for oil and gas prospects? So folks, if that's something you think is interesting, let me know in the live chat here or in the comments if you're watching the replay, and I'll make sure that happens if enough people want that to happen. All right, Steph. Well, look, thank you so much. Really appreciate you doing this, especially with all that's going on. Look forward to seeing you in 4 weeks from now, folks. Yep, tighten your belts. You can make it. And in the interim, folks, to get more Pomboy in between your appearances here, Steph, where should they go?
Macromavens.com. You can find me there, and you can learn how to subscribe. And then on Twitter, and obviously with you, I'm at @Pomboy on Twitter. And we're going to be doing another one of those super terrific happy hour conferences, which I'll post some information about on my website and on Twitter. And maybe you can come meet us in person for that. That'll be in February of next year. So that's a ways off. But here in South Florida, so if you're looking to escape some cold weather somewhere, I'll provide all those details on my Twitter feed soon.
Awesome. And when you come back on next time, Steph, and anytime in between now and then, we've got all the details, URL folks should go to check it out, that type of stuff. We'll let you share it loudly and proudly here, because I know a lot of these viewers would probably love to go do that. The one you guys assembled last year was just, it was like a Justice League of the world's greatest macro analysts. And who wouldn't want to spend the day with Stephanie Pomboy and Grant?
A lot of people.
And Wilhelmina.
Oh, God.
All right, folks. Well, look, just in wrapping up real quick, please show your appreciation for Steph and her continued willingness to come on the program here by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. And if you would like any help from a professional financial advisor in putting into practice any of the opportunities, strategies we've talked about today in your own portfolio, feel free to talk to one of the financial advisors that Thoughtful Money endorses. To do that, just fill out the very short form at thoughtfulmoney.com, and one of our endorsed advisors, whichever one you're matched with, will reach out to you. These consultations are totally free. There's no commitment to work with these firms. It's just a service they offer to be as helpful as possible. Steph, great to see you. Wonderful conversation today. Wilhelmina, she just kept everything on an even keel with her soothing snores.
Yeah, I know. The floor stayed down, which is important. So
yeah, but have yourself a wonderful Thanksgiving.
You too. And we'll reconvene right before Christmas, I guess.
All right. Well, look, everybody, thanks so much for joining us. Steph, thanks so much again.
Thank
and
you.
Everybody else, thanks so much for watching.